Hello and welcome to Masterclass with Utpal Sheth, and what we are discussing is something very unique and very differentiated: mistakes. In the first episode of this series, we've discussed common errors. But in this episode, we would be solely focusing on mistakes. Yes, ladies and gentlemen, mistakes, underline that word, mistakes which have been done by a terminal value investor both in buying and in selling. The spirit here is Mr. Sheth would put in his experience, his understanding, so that you can just benefit from him. These are not recommendations what we will be discussing. This is just a framework which he has implemented and he would like to share with us. So with that spirit, welcome back. Thank you for joining us.
Thank you, Nikunj.
And I must say again that nobody wants to talk about mistakes. It's something which is more like a humbling experience to talk about it, but you've come out on open and a public forum to talk about it. So really thank you very much for that. Mistakes in buying. And that, I think, is the most important thing which we need to discuss. What are the mistakes in buying?
Sure. And Nikunj, before I talk about mistakes in buying, I just want to put this in context that mistakes should not be looked at anecdotally, but one should have a mental framework for looking at mistakes. Only when you have that framework can you analyze it, can you learn from it, and can you rectify it. In the last episode, we talked about the types of errors. Today, we will drill down into those same types of errors, both for buying decisions as well as for selling decisions. And then go into portfolio management, keeping these in mind. So let's first talk about buying, as you said. So in buying also, the same three types of errors, which is type 1, type 1.5 and type 2 errors happen. Type 1 error is where you did not buy what should have been bought, which is the error of omission. I think history is replete with many such episodes. However, to my mind, the type 1 error which pains me the most are companies which have demonstrated longevity as well. Okay. So just because something has gone up 2x, 3x or in the next 6 months does not pain me as much that I did not buy that. What pains me is if a company keeps performing consistently for the next 10, 20 years and I had not bought that. That pains me. Now, it could be because I did not understand it. And that is fine with me because I am also human. I will not understand everything. I cannot build a differentiated insight on every company. So, such a type 1 error of omission where I did not understand is fine. The most painful part of this is where I understood and then let go, maybe for valuation or maybe because I felt that the market overall is too high. Those are the causes which lead to the greatest pain here. So, in buying, this type 1 error of omission is typically caused by concerns on valuation, concerns on market volatility, concerns on global macro commentary, or concerns on political outlook, etc. To my mind, a lot of those is just noise. If you do have a concern, you should still go ahead and buy. Maybe buy less than what you would have otherwise bought. Right? Which leads us to the second type of error, which is the type 1.5 error, which is error of reluctance or error of hesitation, where you had your conviction and you bought less than what you should have bought. The good part is you can rectify this error as your conviction increases, or from what we saw of the first type of error, as the clouds on the horizon or the noise of macro or valuation or political situation, etc., dies down, you can rectify this mistake. What will hurt you the most is if you don't rectify this type 1.5 error, which because your hypothesis was in place, your differentiated insight was in place, your conviction was in place, and you did not back your conviction adequately. That will cause the most pain. And lastly, the type 2 error, where you bought something which you should not have bought. Now, it is not necessary that an error is one where only where you have lost money. Where you have lost opportunity is also an error. And here, see, all of us are human, all of us will have some such lemons in our portfolio. But a lemon where something is fundamentally wrong, which means there is a governance issue or an accounting issue or an outright fraud, and you fail to detect that as an investor and went ahead with that, that causes the greatest pain. Loss of returns is one thing, but something blowing up in your face is worst.
And to avoid type 2 errors, which is it could be governance, it could be change of trend, it could be technology, how does a terminal value investor really apply it? Because when you are looking at terminal value investing, you are looking at climbing the top of the Mount Everest starting from the base camp, which means you would like to give the company or the business liberty of time, perhaps benefit of market conditions, and benefit of what's happening in terms of the general environment. How does one know that, look, I've committed in type 2 error, I need to rectify it?
Yeah. So, type 2 error typically means that your judgment on the management has gone wrong.
Not business, only management.
Usually, yeah, because governance is a management issue. Accounting or a fraud is a management issue, right? Much more than a business issue. So, type 2 errors typically are errors that you make because of mistake on judging the management. Mistake in judging the business will not lead to very large, type 2 errors or very frequent type 2 errors. Now, you have to have your checklist, you have to do your homework, you have your ability to judge people will determine how good or bad you are at type 2. Okay. And we've all learned over time that longevity is vital for compounding, and for longevity, having the right partner is vital. And type 2 errors typically is where you buy something which you should not have bought, which means you have engaged in a partnership with the wrong partner.
Okay. And now flip the coin completely from buy to sell, which is very important also, because ultimately an investor, you want to ride the best of the business and get out before the down cycle starts. From a young company, when you become a high growth company and when you become a flat growth company before you started decaying, investors should actually exit, which is the type 1 error in selling. What is the type 1 error in selling?
So, like in buying, type 1 error is the error of omission, which means you did not sell what should have been sold. Now, given that you are a terminal value investor, you go in with an investment hypothesis that you are going to invest in a potential gorilla. You invest and then figure out that this is not turning out to be a gorilla, but is a monkey, or maybe that the initial investment hypothesis is not correct, and then you should have sold. Irrespective of valuation, I am not talking of timing the market here. Right? Now, this kind of a error happens because you end up falling in love with your stock. Something which has done very well for you is most likely candidate for this kind of an error.
So investing is not ego. It is not falling in love with what you invest. It is about a pure commercial decision which you need to take.
Yes, more than a commercial decision, I will say it is a dispassionate decision making with a balanced mind that is important.
I'd like to throw in one more ingredient, and a very real example here is importance of relevance. I mean, the place where we are sitting was a mill. In 1960s, 1970s, cotton mills in Bombay were throbbing. They were the most exciting business. But now the relevance has completely died down. For a terminal value investor who's thinking of long-term evolution, how do you really understand that, okay, the management was good, it was a gorilla, but unfortunately, that gorilla is now becoming extinct because of its viability. So it's not a monkey, but the sheer importance of that business, of that gorilla, is no longer required in the jungle. How does one figure that out?
Which means the mega trend went against you.
Okay.
Which means the cotton mill mega trend was over. So irrespective of whether you're holding on to the leader in that space or not, you did not have the mega trend with you. Remember that we talked about three things: mega trends, leadership, and intangibles. You need all three.
I'm just connecting all these on purpose so that our viewers can start, relating to them. In case you missed the first series in terms of mega trends, please watch it again. When you're trying to look at, connecting the dots here, please watch the entire series so that you can understand that ultimately it's the matrix and the framework is what we're trying to establish here. Again, there would be a error here which could be called as type 1.5 error in selling. How does that work?
Yeah. So type 1.5 error in selling is where the stock has typically done well for you. You sell a bit, but not enough. Okay. Now, this is typically where you are still in love with your investment. You are only balancing your portfolio despite the fact that the hypothesis has changed. Maybe the mega trend has played out. Maybe there is a leadership issue. Maybe there is an intangibles issue. And yet you did not sell. And then the stock either underperforms or goes into negative. See, a correction in a stock price is not a problem. As Buffett and Munger have taught us, what we are concerned with is permanent loss of capital. We are not concerned with temporary loss of capital or quotational loss, as they say. Type 1.5 error, we are talking about not being able to adequately avoid permanent loss of capital.
And the type 2 error here perhaps is the most important one. You should have not sold where the value is high and the journey in the highway is very long.
So type 2 error situation is such that you've bought something based on a differentiated insight and conviction. That hypothesis has been validated. It has become a gorilla for you. It has already done well for you. Yet, you are anxious or insecure about the gains that you have made, or due to maybe some macro noise, and you expect the market to fall, or you feel that I've just made too much money. I don't want to lose any part of this. I want to lock it in. And that anxiousness and insecurity is leading to you selling what should not have been sold. Now, the opportunity cost of selling what should not have been sold is not just in the quantum of money that you left on the table, but it is also what it does to the weightages in your portfolio. As we go forward, I will try to explain to you how rare it is to be able to find a gorilla. And once you found a gorilla, to give it up for the wrong reason is really a shame.
It's perhaps the most painful mistake you will make, which is that you had it, you knew it, and yet you did not benefit from it. We are putting this chart up on the screen and it's a self-explanatory matrix. Why don't you walk us through scenario 1, scenario 2, and scenario 3, and there are a lot of sub-brackets what we have. So what are we trying to bring out here?
So Nikunj, in a buying decision, there are many variables involved, but the key variables are actually the business, the management, the valuation, the governance, and the financials. Let us say that there are 5 key variables, and there are probably others as well. For any investor, to make the buy decision, he has to be right on each of these 5 decisions to really end up with a multibagger. Right? So we've created scenario 1, 2, and 3, where depending on the quality of investor, your probability of being right for each of these 5 variables is different. So a great investor will probably be right, let's say 80% of time in his decision on the business, 70% of the time in his decision on the management, and so on. But a good investor will be right on the business 60% of the time, will be right on management 50% of the time, and so on. And we could debate these probability numbers, and you please put in any number that you think fit. But the most important mathematical concept involved here is, for you to get a multibagger, for you to get that gorilla, you need to be right on each of these variables. These are and decision points, and therefore you have to think of it as joint probabilities, which means probability of being right on business multiplied by probability of being right on management multiplied by probability of being right on valuation, and so on. That gives you the joint probability. So the joint probability of this being right and you getting that gorilla, if you are a great investor, is 14%.
14%.
14% in this
That
scenario
means if you're
1.
best of the best, only 14% of investments would have been right. If you are numero uno, only 14% probability of getting a multibagger.
14% of getting a long-term multibagger gorilla.
So imagine you got all the check boxes right, you made 100 investments, you will only get 14. And this is like your best of the best.
Yes.
Can I say these numbers actually apply even to, let's say, Rare, Warren Buffett, Charlie Munger, who've been great investors?
I don't want to comment on anybody else's probability, but this is my assessment of the best of the best.
Okay. Which means you will keep on doing mistakes. But when you get it right, the rarity of finding a good gorilla is only 14%, and this is best of the best.
Yes.
And when you get it, please stay with it. That's the point which we need to really, bring out again and again, that once you've been fortunate, lucky, you're the inside, you're the foresight, you use the framework which we discussed in a couple of episodes, and if you identify one gorilla, well, then you should not be in a hurry to sell early or part with it early. Yes. Because mathematically the probability is only 14%.
Yes. But Nikunj, let me extend it a little further. So for the great investor, it is 14%. For a good investor, it is probably 3%. Okay. For a medium investor, it is 6%.
That's 3%.
For a good investor, it is 3%.
Yes.
For a medium good investor, for a better investor, it is 6%. For the best investor, maybe it is 14%. Now, the journey of each investor is to go from that 3% probability to 14% probability. Right? The point is that once you found a gorilla, let's say you start with 10 stocks in your portfolio and 2 of them have become gorillas for you, then given that 14 odd % probability, the remaining 8 you realize you need to change over a period of time, and you will change that over a period of time. However, the next time you are only taking 8 decisions, assuming that you are restricting your portfolio to 10 stocks. Now, out of those 8, let's say you get only 1 right, but you are only taking 8 new decisions. You are no longer taking the decision again on the first 2. Though in my mind, the holding the first one is also, first 2 are also, is also a decision, right? So, as you keep evolving, your probability will keep getting better, and more importantly, the duration of the decisions which have gone right for a terminal value investor is far longer than the duration of a decision which has not gone right for a terminal value investor, and which is why we call this as probabilistic portfolio management, where your conviction determines the weights of a particular stock in your portfolio.
So ultimately it's conviction and differentiated insight which will derive your conviction, and conviction will give you perhaps the courage to invest, and duration is something which would be a function of everything put together. But when you have everything in place, that's the time you really need to stay with the investment. And when you're staying with an investment in a 10-year period, 15-year period, even beyond that, you may see one bull market cycle, two bear market cycle, or vice versa. So these market conditions should not really have an impact on the way you are perceiving your investment, because when stock prices go up and down, that's a NAV loss, that is not loss of permanent capital.
Yes, that is most important, because capital protection is vital, but compounding also is vital. And in compounding, a capital loss will destroy your compounding average.
Now let's reverse that. Which is that when you are taking a decision to sell, it again would be based on business, management, valuation, governance, financial. The same filters work on the reverse. What are the ratios here?
The ratios are different because a sell decision for an investor is only on the stocks that he or she has already invested in, whereas the buy decision is from amongst a much larger base, right? So we said that for the best of investors, approximately 14% probability of getting a long-term multi-bagger gorilla. Then being able to sell it right also has a probability, right? Now, if you don't sell it right, and by selling it right, I don't mean that you catch the top. None of us is God. Nobody is going to catch the top. But being able to sell when there is a fundamental shift in your hypothesis is crucial. If you don't sell, then you end up compromising your long-term compounding. Okay? And in that scenario, let's say that if buying right, buying the gorilla, long-term compounding gorilla, is 14% probability, and then selling it is only 60% probability. Selling it right is only 60% probability. Then that means that in your full cycle of the investing, which is buying, holding, and then selling, your probability is only 8%, because 60% of 14% will give you 8%. This tells you how rare it is to be able to get that kind of compounding and then exit when required. Most people don't get the entry right or don't back the right investments, and when they make the right investments, they get the exit wrong. They sell too early or they sell too late. And I will clarify again, too early and too late is not in the context of catching the top. It is in the context of failing to sell after your hypothesis has been invalidated, which means you override your conviction by your emotion.
So when a terminal value investor is looking at decision to sell, in today's market there is a lot of volatility which comes, sometimes because of liquidity, sometimes because of quarterly numbers. Should one really ignore it?
In the context of terminal value investing, one must ignore them. Okay, because maybe 8 out of 10 times you will be right that you should have sold because of these factors in the short term. But the opportunity cost of missing out on those two right is so high that it overshadows any benefit that you would have got on the tactical selling of those 8.
And I like to remind again, we'll go back to that slide again, that best of the best investors who are called as superstar investors, their probability of getting this entire matrix is only 14%.
Of getting the buy side right
is only 14%.
Is 14%. Yeah. But to get the sell side right as well on the same stock, that will reduce it to 8%.
So these are the things which are important to measure if one is really looking at maximizing gains.
And let me say that these numbers are not by themselves important. I've given you the methodology here. You can put your numbers and make your probability conclusions. But I've given you a framework of why one should look at it as a joint probability, right? And the sell decision as a conditional probability. The buy decision is a joint probability, the sell decision is a conditional probability. And therefore, why having multi-baggers on a long-term basis is so rare.